Hi, welcome to the 7th class of this course on Law and Finance. Today on the program is the Great Financial Crisis, how this event beginning in 2007-2008 was caused and what responses it evoked. In the Zoom session, we're going to discuss the Code of Capital by Katrina Pistor and the Pringle case decided by the European Court of Justice. Now let's get into the Great Financial Crisis. The Great Financial Crisis could, with all caution, be described as the combination of two factors. The first factor was the state of international banking at the time. International banks, or the international financial sector, was characterized by a high degree of deregulation and consequently a high degree of leverage. So institutions had a lot of debt on their book, which means they were highly vulnerable. I described these factors intensely in my last video. So if you have any questions on that, maybe go back to that. And the second factor was excess liquidity being made available to the market, especially by central banks. These two factors, a vulnerable leveraged banking system and excess liquidity, caused an asset crisis of sorts on the housing market in the United States that became systemic. So it's again, like in the case of the Great Depression in the 1920s, 1930s, a local event becomes a global one because of the interconnectedness of international financial markets. Now here, let me provide you with an overview of these two factors. International banking deregulation and high leverage, as I said, I discussed that already, is marked by a number of steps that came by and by. A first step in the 1990s was giving up Glass-Steagall. Glass-Steagall was a rule that provided for the separation of investment banks and commercial banks, and that put limits on the activity and therefore also on the risk that each of these types of companies could have on their books. A second factor was the buildup of shadow banking, for example, money market funds or hedge funds, especially since the 1990s. A third factor was Basel II. The regulatory system for banks decided on an international level to provide a level playing field, but in fact it allowed for lots of leeway for financial institutions to game the rules. For example, it privileged mortgage-backed assets. So if a bank extends a loan and gets a mortgage as collateral, that loan will not require a lot of regulatory capital. Moreover, banks could use other techniques to further lower their regulatory capital. For example, they could provide their internal risk ratings, risk calculations for calculating the regulatory capital. And of course, they did that in a way that was favorable to them. And securitization was another factor that meant that a lot of risky assets were, so to say, outsourced, removed from the balance sheet of a bank and moved towards a special purpose vehicle. And the structure of that vehicle allowed the bank to again save on regulatory capital. Another further factor was regulatory competition, especially among US regulators, because regulators get fees from the institutions they regulate or they supervise. And so, the less demanding you are as a regulator, the more institutions will decide to come under your supervision, and the more institutional leverage you will yield. And for that reason, there was a tendency among US regulators and supervisors to engage in a race to the bottom. Now, the second factor concerns excess liquidity. How did that come to pass? That is mostly the result of low interest rates of the Federal Reserve in the period from about 2002 to 2006. That led to a huge expansion of credit. So interest rates charged by the Federal Reserve for access to its resources were lower than what they probably should have been. Here you see a scale or a table that shows the actual federal funds rate, that's in blue, and compares it to the estimated Taylor rule. Now, the Taylor rule is a mathematical rule that provides guidance for central banks how they should calculate their policy rates, their interest rates charged on banks in order to ensure price stability. And you can see that there were two periods, one in the early 1990s and the other one, even more significant one, in the early 2000s, where the actual interest rate was far lower than what it should have been ideally under the Taylor rule. Yeah. What were the consequences of this excess liquidity? Well, it allowed banks and their customers to finance asset purchases on loans. You didn't have to have a lot of capital in order, for example, to buy a house or to make an investment, to buy shares, to buy any kind of securities. Another contributing factor were excess savings that had accumulated in Asia as a consequence of 1997 to 1998 Asian financial crisis. Many private individuals were worried about yet another financial crisis, and they better put their money to a safe place, which means foreign investments, rather than leaving it on their domestic accounts or investing it in investment goods or consumer goods. And a last factor were banks lacking a clear business model, especially the German Landesbanken, state-run banks that didn't really have a customer base, but that didn't also count as banks necessary for financing the economy. So they tried to do something with their funds, and that meant, in that case, buying mortgage-backed securities on the US market. And those are the ingredients of an asset crisis. You've got vulnerable institutions, a lot of liquidity that goes to mortgage-backed securities. And then this market started to collapse. Initially, this started at a small scale. Prices, real estate prices, ceased to grow as fast as they had grown in the past. In about 2007, there was a stagnation of prices. They still rose, but only a little bit. Yeah, and that stagnation was already too much for some investors because they had been so highly leveraged, because their business model, so to say, relied on steadily rising housing prices. They would only be able to pay back their loan if they could sell the house or the bunch of houses they were invested in at a later point at a significantly higher price that would cover, both the principal and the interest payments on their loan. If this is your business model, you're really running a very, very high risk because it requires only a small worsening of the market situation for you to be no longer able to make ends meet. And it didn't take very long for that to cause consequences for all the financial institutions involved in the mortgage-backed securities market, in the real estate market in the United States. And the first major institution who felt that was Bear Stearns. Bear Stearns had created lots of these special purpose vehicles, SPVs, in the past, where it packed all the mortgage-based securities, all the loans and mortgages that it had extended to people who wanted to build a house. And now the trouble started because more and more homeowners were unable to serve their loans. So at some point, these SPVs, these special purpose vehicles, where all these loans and mortgages were combined, they fell short of cash because people couldn't service their loans any longer. So Bear Stearns had to inject cash into them. And that was something that was not foreseen by the regulation. They did so on the basis of an implicit guarantee because they thought, it would just be too embarrassing if our special purpose vehicles collapse. So we have to make sure that they remain afloat. And that was basically the starting point for a whole cascade of events in which different credit risks materialized. Implicit guarantees, but then also low asset quality because you don't want inject overly much cash. So they tried at some point to sell the assets, the mortgage-backed securities. And then it turned out that the quality of these loans was just too bad that they couldn't really sell them at a sufficient satisfactory price. So selling the assets did not generate enough funds for keeping the special purpose vehicle alive and meeting the financial obligations. So what do you do in that situation? You have to sell even more assets, which leads to even further price declines. Then you're in this downward spiral of asset price decline. Ultimately, the precipitous development of Bear Stearns was stopped by an intervention shouldered both by JP Morgan and the Federal Reserve. That was different, as you all know, for Lehman and Brothers. Lehman and Brothers was not saved. And Lehman and Brothers had a very similar structure. They also had extended lots of mortgage-backed securities, but the difference was they did not put them into a special purpose vehicle, but kept it on their books. So any decline in the asset price had an immediate effect on the balance sheet of Lehman and Brothers. It's a high-risk strategy, but they thought that they could make more money of it in that way. And so the decline in the asset price at some point caused the collapse of the institution because it lost rapidly, its assets lost rapidly in value. At some point, if the assets on this side of your balance sheet depreciate, at some point your capital shrinks because your liabilities stay the same. You still got money from depositors, you still have loans by which you finance yourself. At some point you have no own capital anymore. And then you're basically bankrupt. And in this case, the US government decided not to save Lehman Brothers. And that was the beginning of a systemic crisis. Now, that crisis could unfold in a systemic way because all the actors on the financial markets were so highly interconnected. And because all of them were highly leveraged. So, the shock met institutions that were relatively vulnerable and that were relatively open to the impact of other institutions, including institutions in other jurisdictions. That is what happens if many, many institutions around the world offer similar products and similar investment strategies. If asset prices decline, it will automatically, in that case, affect a lot of institutions. When Bear Stearns began selling its mortgage-backed securities, they had an impact on the entire real estate market. So every other institution invested in that real estate market, and there were many of them, also faced a considerable impact. Moreover, not only had they invested in similar products, they also had financed themselves in similar ways, for example, through special purpose vehicles or through money market funds and other funds or entities which are based on a mismatch of maturities. They usually had made long-term investments like mortgage-backed securities, loans that run for decades, but their refinancing was usually short-term. So if you have short-term refinancing needs, it might mean that you will have the need to get access to cash relatively quickly. Now the problem is, if everybody follows the same strategy, and if everyone's assets are impacted by a crisis on real estate market, then everybody will have to sell assets very quickly to get access to cash to meet their refinancing obligations. And if everybody is doing that, the result will be that asset prices decline even further, and there is a spiral that can quickly get out of control. And the US government under Bush clearly did not see that when they did not solve Lehman Brothers, and then the disaster was already there. Within just a few days, everything literally collapsed, and the mistrust among institutions became intense. No one believed that their counterparty would still be afloat the next day, literally. And so you don't give credit to one another. So the cash needs of all these entities were even multiplied by this drying up of any reasonable market for credit. And the crisis spread quickly, and it spread globally. Here are some notable events. I cannot go through all the events in detail, but just some things. So One decisive event was the collapse of the money market funds in September 2008. They had invested a lot in mortgage-backed securities. So they faced a lot of difficulties once Lehman Brothers collapsed and the market for mortgage-backed securities was in free fall. And the problem was that there was no one to save them because they were not really, regulated like normal banks, even though they had a function of a shadow bank. So there was no lender of last resort. No one could provide them with the liquidity they needed, even though they still had a lot of, assets on their books that might also increase in price at some point in the future again. They had a short-term liquidity shortage, which no one could help them to get out of. The crisis did not only affect vehicles invested in mortgage-backed securities, it also affected insurers. Remember, buying insurance, so-called credit default swaps, was one of the ways of ensuring you get a very good credit rating and you have to provide only very little regulatory capital for mortgage-backed securities. Now, the problem was that a company like AIG extended a lot of insurance for a lot of mortgage-backed securities. Now, if the entire market for mortgage-backed securities declines, AIG had to make massive payments to those who had bought insurance. And that led basically to its technical default, only that it was saved by the US government because, an insurer also insures a lot of things apart from credit default swaps or apart from mortgage-backed securities. And the US government did not want to expose the people to the loss of essential insurances. Moreover, due to the global character of the mortgage-backed securities market, banks in other jurisdictions were heavily affected. One example is Germany's Landesbanken, a subsidiary of them, Hypo Alpe Adria, failed and then had to be saved by the government by building a bad bank, etc. In the UK, Northern Rock experienced serious trouble and also had to be basically fell bankrupt and had to be bailed out. And in Iceland, the financial sector had reached a level at which the default of its major banks actually became life-threatening for the economy. So Iceland itself could not really provide any bailout because the economy was too small. The financial sector was multiple times the volume of the entire Icelandic economy. And so the Icelandic funds were saved by the governments of the Netherlands and Great Britain and the UK. They later tried to get the money back from Iceland, but Iceland refused. Said, it was your business that you did that. Well, Iceland didn't do a proper job in supervision, but at some point there's no obligation for government to bail out. Now, what were the reactions to the financial crisis on the part of governments? The first and most important reaction in such a crisis is to stop it. And you stop it by providing liquidity to institutions which have a cash shortage but are otherwise healthy. And that is and has been the job of central banks. So therefore, the Federal Reserve and the European Central Bank acted as lenders of last resort, LOLR, and expanded their monetary base. They just printed money basically and put it on the market and offered it to banks against collateral. They also increased the amount of collateral that they were willing to accept, or the kind of collateral they were willing to accept, and tried to provide them with the liquidity they needed, considering that the interbank market, like the trust among institutions, had collapsed, and therefore institutions had no other way to gain access to credit other than central banks. And here is a graph that shows this step up in liquidity. You see that the European Central Bank, the blue line, started already before the crisis hit in September 2008. They probably saw it coming because the trouble was already looming on the mortgage-backed securities market. The Federal Reserve did not react proactively, but then it reacted even stronger, as you can see in the red line, and put a lot of liquidity there on the market. And it has stayed there since that point. It has even further decreased as a consequence of the corona crisis in 2020. So what the Federal Reserve and the European Central Bank did were to put up special asset purchase programs by which they, tried to provide liquidity by supporting the asset market or specific asset markets. I can't go to all the details here, but that, of course, then was challenged in the European Union before the European Court of Justice. That is the case of the background of the Gauweiler judgment, which we're going to discuss in the next session, so in class number 8. The ECB mostly invested in sovereign debt in the course of the European sovereign debt crisis, whereas the Federal Reserve mostly invested in commercial papers and in different kinds of securities. Another reaction was fiscal in nature. Governments bailed out troubled banks and other financial institutions, quite along the lines of the measures taken by the US government in case of AIG. Normally that meant that the government purchased shares. It became an owner of that company and provided fresh liquidity for it. And the bad assets were sometimes outsourced to so-called bad bank, which then was restructured or dissolved and trying to sell whatever they could sell at whichever price. A third, more medium-term reaction was also fiscal in nature. Governments around the world, especially in the industrialized countries, of course, tried to restart their economy by setting up public investment programs, quite along the Keynesian logic of demand-driven economic growth. One famous example was the German Abwrackprämie. That was a premium that citizens could apply for if they exchanged their old car with a new car. And the new car had to meet certain requirements in terms of pollution. And that, if there's anything positive to be learned from it, it shows that maybe a crisis and the role that it gives to the state can also be a contributing factor for advancing necessary policy and technological changes. I think we see a lot more of that in the Corona crisis, in the COVID crisis, where governments, especially at the level of the European Union, quite resolutely insist on investments into climate technology and digital technology, etc., to also contribute to the necessary transformation of the economy. Of course, you can doubt whether what they do is sufficient, but I think that's a debate for another day. Now, the crisis also triggered a number of regulatory responses. So at the international level in the United States and at the level of the European Union, the regulatory framework for financial markets was modified in certain ways. I think that overall what you could say is that this change has been incremental rather than revolutionary. So there has been a lot of reform contributing to tighter rules, covering more actors, but it's not really been a decisive step away and a switch to a completely different regulatory model. Anyway, let's look at what they did. At the international level, we now have a better overall structure for financial regulation. The G20, the informal organization of the 20 largest economies in the world, now serves as a comprehensive forum for all these questions and takes the major political decisions and gives the impulses which then other actors in the system, be it international organizations like the International Monetary Fund or regulatory institutions like the Basel Committee, implement. They also added a system for macroprudential supervision, that means for the control of systemic risk, and that is exercised at the international level by the Financial Stability Board, which is kind of part of the G20. Microprudential supervision also changed. Microprudential means supervision of individual institutions for their individual risk. A lot of the international standard setting bodies stepped up their rules in the aftermath of the financial crisis. That includes the Basel Committee, but also insurance supervisors, the International Organization of Securities Commissions, and accounting standards being fundamentally important for the calculation of regulatory capital. I'll restrict myself here to the changes to the financial regulatory framework for banks. Basel III became the successor of Basel II, and it modifies it in a number of ways. For example, it demands more regulatory capital from banks. It strengthens their core regulatory capital, which they need to hold, especially systemically important institutions. Now, it introduced this divide between normal institutions and systemically important institutions because it turned out, systemically important institutions are either so highly interconnected or are so big that the government will, in the event of a crisis, probably decide to bail them out, like AIG. And for that reason, because they will be bailed out, they need to have a lot of regulatory capital. So in order to minimize their potential impact on fiscal policy, on the public purse. The leverage ratio was also introduced as a cap on the maximum leverage that any institution may have at any point in time. And the Basel III framework introduced so-called counter-cyclical capital buffers. That means that institutions need to step up their capital in good periods, so to be on the safe side if things turn worse. The US government or the US Congress adopted the Dodd-Frank Act, which also introduced a couple of measures. For example, macroprudential supervision was attributed to the Financial Stability Oversight Council, a new council. So far, there was no macroprudential systemic supervision. They introduced an orderly liquidation authority, which should make it more likely that institutions get bailed in or get dissolved in case of crisis and don't have to get a bail out by government. And they stepped up supervision for shadow banks, especially for hedge funds and for private equity funds. They introduced the supervision for credit rating agencies, which had this very problematic role in the regulatory framework preceding the financial crisis. The US introduced a new rule for proprietary trading, a rule for banks that want to hold assets on their own books, like Lehman Brothers. They can do so only up to relatively strict limits, because that would expose them to full force of a crisis. And they also introduced the Bureau of Consumer Financial Protection, which was established especially on the initiative of Senator Elizabeth Warren. Now let's take a look at the European Union. European Union implemented the new Basel standards in a new regulation and a new directive. It adopted a regulation for rating agencies, and it stepped up the conditions for mortgage loans in the Mortgage Credit Directive. Now you have to have more capital before you get a loan, just to ensure that house owners are not so terribly leveraged. And then, though only after the sovereign debt crisis, which we're going to discuss in class number 8, the European Union also introduced the Banking Union, which comes with a completely different framework for bank regulation that includes a single supervisory mechanism, so a central supervision for banks in the Eurozone, a single resolution mechanism, which is to make sure that there aren't too many bailouts. And still pending is the introduction of a really unified, solidary single deposit insurance, even though they stepped up the rule in that respect. The capital market in the European Union, however, still remains fragmented. We will say a little bit about that in the last class on cryptocurrencies. That was all for today. I know this was a longer session, but the financial crisis is really a complex event. I hope that I could provide you with some salient points and a little bit of an overview, and I'm looking forward to discussing Katerina Pistor's Code of Capital with you. See you then.